Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. Welcome to Next Level Charting. Today, I want to do a performance overview covering the leaders and the laggards in 2020. We'll see that gold and bonds are holding up well despite the surge in SPY. We're going to review the Keltner channel break in SPY and show you that finance and industrials are lagging. So I want to start off with a little performance overview to see how things are performing year to date. And what I've got is a master ETF chart list that I use. And you can see there it's got 199 charts, ETFs. I used to have 200, but I think I had to remove the Swedish krona for some reason. I think it stopped trading. And they're organized in a top-down manner. You can see the major index ETFs. And then I go down into factor ETFs, growth value ETFs, sectors, industry groups, bonds, and so on. And so once you've got a list like this, it's really easy to get a performance overview. So I'm going to click View List As, and I'm going to click Summary to view that in summary format. So once you've got this list in summary view, as I do here, the default's going to be intraday. But I'm going to change this to year to date. And now I've got the year to date performance. And I also removed a bunch of columns because I don't need these columns that are shaded out here. I just want percentage change and the plus minus box there. You can see that's nice because you can compare the size of those boxes. So what we have is the major index ETFs here at the top. And I can right away see that one is holding up better than the others. And that would be the one, of course, with the smallest red line there. And if you look over, you can see it's the NASDAQ 100 Trust. And look who's lagging. That would be small caps are lagging, the Russell 2000 and the S&P Small Cap 600. So if I'm looking somewhere, I want to be looking at the NASDAQ 100 because that's where the relative strength is this year. That's one that is holding up right now. Now, I'm not advocating running out and buying the NASDAQ 100 because as you'll see, I'm still in bear market mode. I think this is a bear market rally. At best, we're in a trading range. At worst, we're in a bear market. But you do need to keep a short list of things you want to follow that maybe you want to look at on a pullback. And QQQ would be at the top of my list for the major index ETFs. Now, another one I want to look at here is the sectors. I'm going to skip the factor and the growth value. I really don't use those too much, but we will look at the sectors. And you can see here, this is the sector SPDRs right here that I've outlined. And I want to see which ones are performing well. And again, with these little red hash marks, lines, whatever you want to call them, you can easily single out which ones are performing best because they have the smallest red lines. All of them, incidentally, are down. But technology is down the least. And there's healthcare, it's down 6%. Sorry, consumer staples is down 6%. And healthcare is down 5.5%. So those are the three sectors that you might want to watch going forward. Utilities and REITs are also holding up. But I like these bigger, broader sectors personally, so I'd keep my eye on technology, healthcare, and staples. Now, I've also got the equal weight sectors and the small cap sectors. As you can see here, all small cap sectors are down, and utilities is down the least, but it's still down almost 11% year to date. And then I get into the industry group ETFs, and these are organized according to sector as well. And the one sector, again, that stands out is technology, because you can see software is just down 2% year to date. It's got a small red, I can't get a name for this, a small red dash. So software is performing well, internet is holding up well, and cloud computing is holding up well. Cybersecurity not doing too bad either. So those are areas of the market that have held up relatively well. And so if the market does, pull back after this big move and then turns back up, those might be groups to consider going forward. Now, again, it's real easy to see just by comparing the red hash marks on the right. These are all big red marks, so these are down a lot. Solar energy holding up, no big deal. Biotech has a small red hash mark, so it's holding up relatively well. And medical devices is holding up relatively well. So those are ones you might want to put on a short list. Gold miners are up a little bit. Personally, I'm not interested in gold miners. And then you can see where the green is. It's in the treasury bond market, namely TLT. So there isn't much that is up this year. TLT is, and gold. Gold's up 13%. So then we get to the international ETFs, and we can see a lot of red on the right-hand side, but two stand out. That would be the China Technology ETF and the China Internet ETF. So China is holding up relatively well. They are further along than any other country when it comes to COVID-19 as far as the maturity of the virus being in the land is concerned. So let's take a closer look at bonds and gold here. And one thing I found very interesting was, this huge rally in the S&P 500, up over 25% in a relatively short period of time, like 3 weeks. And during that time, TLT was basically flat here. All right, there's when SPY bottomed, that long white candlestick, and we had a dip and a bounce and a dip and a bounce. And, given the surge that we had in SPY, I would have expected TLT to pull back, maybe back to the 150 area. But the fact that it held strong told me that maybe there's not as much risk on as we would think in the market overall. And then when we kind of look at the pattern here, I'll show you this pattern on a weekly chart, which is the one right below that. We got a little bull flag taking shape in TLT. Now, personally, it's a little bit too volatile for my blood. I mean, look at these 4 candlesticks here. But after this volatility, we've had 2 small candlesticks, and then this is this week's candlestick. And it looks like a surge and a little flag, and TLT could be ready to continue higher. And if TLT continues higher, that would show more risk off, risk aversion, and that could be negative for stocks going forward. One more thing is we've got RSI, 14-week RSI in the indicator window, and it moved into its bull zone there in December 2018. And the bull zone ranges from 40 to 80, 90 roughly. There you can see that. And every time we hit that 40 to 50 zone, we got a bounce in TLT. So we got one here in November and December. Didn't even pull back here. But clearly when RSI is in that 40 to 80, 90 zone, that's the bull zone for momentum. And pullbacks to that 40, 50 area act as momentum support. So now let's look at gold. And this is another thing. Gold is an alternative. It's an alternative to basically everything. It's an alternative to the dollar. It's an alternative to stocks. It's an alternative to bonds. But what happened here? Well, here's the stock market surging, this big move to risk off. And at first, gold moved down. But then gold just surged. And we probably all know the reason why gold surged. It is, of course, because the Fed is doing QE to infinity, basically. Their balance sheet is going to expand. It's going to hit 8 trillion soon and could hit 10 trillion. It's just mind-boggling. And that might be why gold is moving higher. And again, the fact that gold is moving higher, the fact that bonds held up when the stock market surged tells me we're not quite out of the woods here, if you will. And then if we look at a weekly chart for gold, nothing much going on here other than the new high. It's pretty volatile. Kind of got to let it come to you, wait for a setup. But again, here's RSI, 14-week RSI, and it's been in that 40 to 80, 90 zone since the since December 2018, like TLT. And you got bounces off of that 40 to 50 zone that gave you a opportunity to partake, and the last bounce was in mid-March. Now, last week I talked about SPY moving from into the caution zone and what would mark the danger zone. And I updated that on trendinvestorpro.com on April 15th with a chart. First of all, I showed the longer term outlook for SPY, and we've got Keltner channels here, 125-day, and you can see 3-period for the ATR with there. And there was the break below that lower channel in late February, just like we got the break in October. And so that's kind of like the long-term bearish signal. And there we can see the normalized ATR turning up as volatility expands, and that's bearish. And as long as we have high levels of volatility with these two indicators and the breakdown, we're in a bearish configuration long-term for SPY. And then I also noted that 20-day highs started to contract. Here's a chart showing percentage of 20-day highs in the S&P 500. And this is the peak from January to February. It's a much lower peak in the percentage of stocks making 20-day highs, even as SPY hit a new high. And so that led to the peak that we had there in February. There you can see the upturn in 20-day lows. And if you look here, on Friday, we had a big surge in stocks making 20-day highs to 45%. And then we had a low number of 25.35% on Tuesday. And the S&P 500 SPDR was up like 3% and hitting a 20-day high. So participation was narrowing. And so that tells me that, we're in a bear market configuration long term. We see a little bit of deterioration in breadth. And then you look at the retracement here. You had this big decline, and there's a retracement just above the 50% zone. So you're in this 1/3 to 2/3 retracement zone, and that's kind of that's a red flag because you don't want to buy when you're getting close to the 200-day moving average and you're in a bearish configuration, and that's a wedge. So we could be poised to move lower. Now, if you look at the 11 sector SPDRs, which I have here, and the 200-day, you can see that only 2 are above the 200-day, XLK and XLV. The other ones are below their 200-day. XLP is the closest to its 200-day. So until you get the majority of sectors above their 200-day moving averages, you can't be talking bull market. And if you look at these charts closer, you can see a lot of rising wedges. And then on the indicator window, I've got the 50-day stochastic, fast stochastic. So 50 days covers roughly that period from late January to now. And that number there for the fast stochastic basically tells you how much they've retraced of this decline here. And if you look where the weakest retracements are, you can see that we have energy 28%, so not much at all. Financials, 30%, very weak. And industrials, very weak, 33%. So with financials and industrials dragging their feet, I don't see this market making much more headway to the upside. All right, so that concludes this edition of Next Level Charting. Thanks very much for tuning in. Remember, you can follow me on Twitter @ArthurHill and visit my website, trendinvestorpro.com. Have a great day.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.